Welcome back to XRP Hub. The latest development surrounding XRP represents a structural shift rather than a routine update, and the distinction is critical. What has just been released signals strategic positioning within the evolving digital asset infrastructure, not merely incremental product expansion. Markets initially reacted with curiosity, but institutional observers immediately recognized the broader implications for liquidity routing, tokenization rails, and cross-border capital settlement. This moment arrives at a time when global financial architecture is undergoing measured recalibration. Central banks are reassessing monetary transmission mechanisms, sovereign debt markets remain under structural strain, and liquidity fragmentation continues to expose inefficiencies in cross-border settlement. Within that environment, infrastructure announcements carry far more weight than short-term price movements. The significance of this development must therefore be analyzed through a macro lens rather than through speculative excitement. XRP's function has always been tied to payment efficiency, liquidity bridging, and interoperability across financial systems. What has just been introduced strengthens that thesis materially. Macro framing: global liquidity cycles are transitioning. After an extended period of aggressive tightening from the Federal Reserve, the European Central Bank, and other major monetary authorities, forward guidance is gradually shifting towards stabilization and selective easing. Yield curves remain distorted, sovereign bond issuance continues at elevated levels, and capital efficiency is becoming paramount for institutions operating across jurisdictions. Cross-border settlement remains one of the largest structural inefficiencies in global finance. Traditional correspondent banking networks require layered intermediaries, pre-funded accounts, and fragmented compliance rails. In a world where liquidity costs are rising and regulatory reporting is intensifying, those inefficiencies are increasingly untenable. Simultaneously, tokenization is moving from theoretical exploration into operational deployment. Government bonds, money market funds, real estate instruments, and structured products are being digitized onto distributed ledgers. Institutions are not experimenting casually, they are constructing programmable liquidity frameworks that reduce settlement time and collateral friction. Against this backdrop, digital assets that provide interoperability rather than speculation become strategically important. XRP's original design as a bridge asset between fiat currencies and tokenized instruments places it directly within this macro transition. The timing of this latest development is therefore not accidental. Event breakdown. The newly announced expansion involves deeper integration of XRP-related infrastructure into institutional-grade liquidity systems. The development enhances on-demand liquidity corridors, strengthens tokenization compatibility, and introduces additional compliance-aligned features designed for enterprise usage. It represents a progression from experimental adoption towards structural embedding within financial rails. More importantly, the integration architecture reduces reliance on legacy pre-funded Nostro accounts. By leveraging real-time settlement pathways, institutions can reallocate trapped capital and improve balance sheet efficiency. This is not cosmetic enhancement, it directly impacts cost structures and liquidity velocity. The update also reinforces interoperability between tokenized assets and cross-border payment channels. As financial institutions begin issuing tokenized instruments, seamless conversion between those assets and fiat liquidity becomes essential. XRP's ledger architecture enables that bridge function without introducing excessive settlement latency. Initial market reactions focused on surface-level interpretations. However, deeper analysis reveals that this announcement aligns precisely with the direction of global financial digitization. Institutions are building rails, not trading narratives. Why this matters for crypto. The broader crypto market remains heavily influenced by liquidity conditions. Bitcoin responds to monetary expansion cycles, Ethereum responds to risk appetite and decentralized finance flows, and alternative assets often mirror speculative momentum. However, infrastructure-based assets behave differently. When a protocol integrates into institutional systems, its valuation becomes partially tied to transaction throughput rather than retail sentiment. This reduces volatility over time and increases structural demand. The distinction between speculative capital and operational capital becomes central. Operational capital moves through systems because it must, not because it chooses to speculate. If financial institutions route payment corridors through XRP-enabled liquidity bridges, transactional demand becomes persistent. That creates a fundamentally different demand profile compared to cyclical retail inflows. Crypto markets are gradually bifurcating between assets that function as macro liquidity proxies and assets that function as infrastructure rails. XRP increasingly fits into the latter category. This development accelerates that separation. XRP-specific impact. For XRP specifically, the immediate impact lies in increased transactional utility. As additional corridors activate and tokenized asset compatibility expands, XRP's bridging function gains measurable throughput. Transaction velocity, not narrative intensity, becomes the key metric. The removal of capital inefficiencies within correspondent banking structures enhances XRP's appeal to treasury departments. When institutions can free previously immobilized liquidity and reduce settlement risk, adoption decisions shift from experimental to strategic. Liquidity pools deepen as corridors expand. Deeper liquidity reduces slippage, improves price stability, and encourages further participation. This creates a reinforcing cycle. Greater adoption leads to stronger liquidity, which then attracts additional institutional usage. Importantly, this development strengthens XRP's positioning within the broader tokenization ecosystem. As digital securities and tokenized money market funds proliferate, conversion mechanisms become essential. XRP's role as a neutral bridge asset becomes increasingly relevant. Institutional adoption is rarely driven by ideological alignment with decentralization. It is driven by cost reduction, efficiency gains, compliance clarity, and capital optimization. The newly introduced enhancements address each of those priorities directly. Banks operating across multiple jurisdictions face growing regulatory capital requirements. Trapped liquidity in Nostro accounts represents inefficiency in a capital-constrained environment. On-demand liquidity solutions offer measurable improvements in return on equity metrics. Asset managers exploring tokenized instruments require reliable settlement layers. Fragmented blockchain ecosystems create interoperability friction. XRP's ledger design, combined with institutional-grade APIs and compliance integrations, reduces that friction. Furthermore, institutions prioritize predictable governance and regulatory engagement. Infrastructure providers that actively coordinate with policymakers gain credibility. This announcement signals continued alignment between technological expansion and regulatory navigation. Regulatory angle. Regulation remains the defining variable for long-term digital asset viability. Jurisdictions are converging toward frameworks that differentiate between securities, commodities, and payment tokens. Clarity is replacing ambiguity, albeit gradually. XRP's positioning as a bridge asset used for payments and settlement aligns more closely with payment token frameworks than with speculative security classifications. As regulatory clarity improves, institutional hesitation decreases. The integration announced reinforces compliance-first architecture, built-in reporting capabilities, identity alignment features, and audit transparency mechanisms reduce regulatory friction. Financial institutions require these safeguards before scaling usage. Moreover, global regulatory harmonization efforts are accelerating. The European Union's MiCA framework, Asia-Pacific digital asset licensing regimes, and evolving US policy discussions all signal maturation. Assets embedded within compliant infrastructure benefit disproportionately from this maturation. Short-term outlook. In the short term, price volatility remains influenced by broader market liquidity conditions. Bitcoin's movements, Federal Reserve communication, and risk appetite in equity markets continue to affect crypto valuations broadly. However, technical structures for XRP reveal strengthening support zones as liquidity depth increases. Expanded transactional corridors provide underlying demand floors. While speculative spikes may occur, structural support becomes more visible. Liquidity zones between major resistance levels remain relevant for traders, yet underlying adoption developments often precede price realization. Markets frequently reprice infrastructure assets with delay. Therefore, near-term consolidation should not be misinterpreted as stagnation. Infrastructure maturation tends to precede valuation expansion. Long-term outlook. The long-term outlook depends on whether global finance undergoes gradual institutional integration or systemic reset. Current evidence favors gradual integration. Central banks are not abandoning fiat systems, they are digitizing them. Tokenized bonds, central bank digital currencies, and regulated stablecoins indicate evolutionary change. Within that evolution, interoperability layers become foundational infrastructure. XRP's architecture aligns directly with that need. As global liquidity cycles normalize and monetary easing resumes selectively, risk capital will re-enter digital asset markets. Infrastructure assets with proven institutional utility may capture a disproportionate share of that inflow. If tokenized asset markets reach projected multi-trillion-dollar valuations over the next decade, conversion and settlement layers will require scalable bridges. XRP is structurally positioned within that intersection. Final insight. The importance of this announcement lies not in immediate price action, but in structural positioning. Financial systems are digitizing methodically, not dramatically. Infrastructure layers that enable liquidity efficiency, regulatory compliance, and interoperability will define the next phase of digital finance. XRP's expanding integration into institutional-grade liquidity frameworks reflects that transition. Capital flows toward efficiency, regulatory clarity supports adoption, liquidity cycles eventually amplify structurally embedded assets. This development reinforces XRP's role within the evolving architecture of global settlement. It signals progression from narrative to infrastructure. The implications extend beyond individual corridors or transactional upgrades. They reach into the mechanics of how capital will circulate in a digitized global economy. When infrastructure reduces settlement time from days to seconds and frees dormant capital, systemic efficiency compounds over time. Macro framing, continued sovereign debt levels across developed economies remain elevated. Governments are issuing record volumes of bonds to finance fiscal deficits, while central banks are navigating the delicate balance between inflation containment and growth preservation. In such an environment, capital efficiency is no longer optional. It is structural necessity. Banks must manage liquidity buffers more precisely than at any previous point in modern financial history. Basel III requirements, stress testing regimes, and cross-border supervisory coordination all constrain balance sheet flexibility. Reducing trapped capital through real-time liquidity solutions directly enhances systemic resilience. Simultaneously, emerging markets are seeking faster, lower-cost settlement mechanisms to integrate into global trade networks. Dollar dominance persists, yet multipolar trade alignments are expanding. Settlement layers capable of bridging currencies without excessive pre-funding requirements gain geopolitical relevance. The digital asset sector intersects with this transformation by offering programmable settlement infrastructure. XRP's ledger architecture was designed for speed, low transaction costs, and interoperability. As macro pressures intensify, those characteristics become strategically aligned with institutional objectives. Event expansion. The specific enhancements introduced strengthen interoperability between XRP-based liquidity solutions and tokenized asset platforms. Financial institutions experimenting with digital bond issuance or tokenized fund structures can now connect settlement flows more seamlessly into cross-border payment rails. This reduces operational complexity. Instead of maintaining siloed blockchain deployments for each asset class, institutions can integrate settlement through a unified liquidity bridge. Operational simplicity translates into lower risk exposure and easier compliance management. Additionally, the integration improves transparency in transaction tracking. Institutional-grade analytics and reporting capabilities allow compliance teams to monitor flows without sacrificing settlement speed. In an era of heightened anti-money laundering scrutiny, that combination is essential. The update also signals continued development momentum. Infrastructure projects that stagnate lose institutional confidence. Continuous technical enhancement reinforces long-term viability. Why this matters for crypto markets. The broader crypto ecosystem is transitioning from speculative enthusiasm to infrastructure consolidation. Projects without clear utility face declining capital allocation as risk appetite normalizes. Conversely, protocols demonstrating measurable integration into financial systems attract longer duration capital. As liquidity conditions improve in future cycles, capital will likely concentrate in assets perceived as structurally embedded rather than purely narrative-driven. This creates divergence within the market. Infrastructure adoption becomes a valuation anchor. Moreover, regulatory clarity disproportionately benefits assets with institutional alignment. When frameworks become explicit, capital that previously remained sidelined can deploy with confidence. XRP's ongoing compliance-oriented integration positions it advantageously within that shift. XRP-specific structural positioning. XRP's role as a bridge asset depends on liquidity depth and corridor activation. Each additional integration enhances network effects. The more institutions route flows through the ledger, the more efficient and attractive it becomes for new participants. Network effects in financial infrastructure compound non-linearly. Once a threshold of liquidity is reached, switching costs for institutions increase. This creates defensible positioning against competitors offering fragmented solutions. The enhanced compatibility with tokenized assets expands XRP's potential utility beyond traditional remittance corridors. It connects to capital markets digitization, trade finance modernization, and treasury management optimization. Transaction volume metrics will provide tangible evidence of this expansion over time. Institutional adoption manifests in throughput data, not social sentiment. Institutional allocation dynamics. Institutional investors allocate capital based on risk-adjusted return expectations and structural durability. Assets embedded within operational systems exhibit lower long-term obsolescence risk. That influences portfolio construction decisions. As digital asset exchange-traded products gain regulatory approval across jurisdictions, allocation committees will differentiate between store-of-value proxies and infrastructure enablers. XRP increasingly fits within the latter category. Furthermore, custodial solutions and compliance frameworks have matured significantly. Large asset managers can now hold digital assets within regulated environments. Infrastructure-focused assets may benefit from this custody evolution as institutions seek exposure to settlement layer growth. Regulatory evolution. Regulatory frameworks are gradually distinguishing between decentralized commodities and payment-focused tokens. Clarity reduces litigation risk and enhances institutional participation. Ongoing policy discussions in major economies indicate recognition of blockchain's role in financial modernization. Cross-border regulatory coordination is improving. Financial Action Task Force guidelines, regional licensing regimes, and central bank consultations are creating a more predictable environment. Assets capable of operating within these frameworks gain competitive advantage. The compliance-forward enhancements associated with this announcement demonstrate anticipation of that regulatory trajectory. Rather than resisting oversight, infrastructure providers are integrating it. The short-term market mechanics. In the immediate horizon, XRP remains sensitive to overall crypto market liquidity. Correlation with Bitcoin persists during periods of macro-driven volatility. However, structural announcements often establish medium-term support zones. Market participants monitoring order book depth and derivatives positioning will likely observe gradual strengthening in liquidity clusters. These shifts often precede sustained upward repricing when macro conditions align. Patience is required. Infrastructure adoption compounds over quarters, not days. Long-term structural thesis. The digitization of finance is not speculative conjecture, it is observable progression. Central banks are piloting digital currencies, asset managers are tokenizing funds, corporations are exploring blockchain-based treasury operations. In such a system, interoperability becomes foundational. Fragmented ledgers cannot support global capital flows efficiently. Bridge assets capable of facilitating seamless exchange across tokenized and fiat systems become core infrastructure components. XRP's expanding integration reflects positioning within that structural transition. As liquidity cycles eventually turn expansionary and global risk appetite stabilizes, assets embedded in operational rails stand to benefit from both transactional demand and renewed capital allocation. The long-term thesis, therefore, rests on three converging forces: global liquidity normalization, regulatory maturation, and institutional digitization. Each reinforces the relevance of efficient settlement layers. Final insight. Financial markets evolve through incremental structural shifts rather than dramatic overnight transformations. The recent development surrounding XRP represents one such shift. It strengthens interoperability, enhances compliance alignment, and deepens institutional integration. Liquidity efficiency drives adoption. Regulatory clarity sustains it. Network effects defend it. Within the emerging digital financial architecture, assets that enable capital to move seamlessly across borders and asset classes occupy a strategic position. XRP's trajectory increasingly aligns with that infrastructure role. As global liquidity conditions cycle and tokenization accelerates, structurally embedded settlement layers may define the next era of digital finance. Thank you for watching XRP Hub.